Welcome back to Algobot, the channel where we break down automated trading strategies line by line. I'm your host, and today we're exploring an expert advisor for MetaTrader 5 called the Camarilla Edge Reversal Hedge. This is a pure price action system. There are no moving averages and no oscillators here. Instead, it's built entirely around Camarilla pivot bands and engulfing candle patterns. By the end of this video, you'll understand how it fades the band edges, how it rides genuine breakouts, and how its hedging layer manages a position caught on the wrong side. Remember, this is educational analysis only, never financial advice. Let's get started. So what exactly does the Camarilla Edge Reversal Hedge do? At its heart, this expert advisor watches a ladder of Camarilla pivot levels. Each time a new bar closes, it looks back over a set number of completed bars, 20 by default, and it measures the highest high and the lowest low across that window. From that range, it builds a family of pivot lines, an upper pair called H3 and H4, a lower pair called L3 and L4, and a central pivot it labels P. The H3 and L3 lines are the classic fade edges, the levels where price is considered stretched. The H4 and L4 lines sit further out and act as the breakout boundaries. The central pivot P is the reversion magnet, the level the strategy aims back toward on its reversal trades. The market it's designed for is a liquid foreign exchange major, something like Eurist on a 5-minute or 15-minute chart, which is the natural home of Camarilla pivot scalping. Because every distance is scaled by the measured range rather than by fixed point values, the same logic adapts to different symbols and changing volatility without retuning. What kind of trader is this suited to? Someone who is curious about combining several classic ideas into one framework. The strategy folds 3 behaviors together: a mean reversion fade at the band edge, a momentum breakout through the extreme band, and a hedging layer that lets a breakout position open alongside an opposing reversal position to manage the transition. It also includes a spread filter and a minimum reward to risk check, so cramped setups are simply skipped. As always, trading carries real risk. Losses do happen, and nothing here is a promise of any outcome. This is purely an educational walkthrough of how the code behaves. Let's walk through the exact logic, step by step. The expert advisor acts once per newly closed bar on its chart time frame, so it never reacts to an unfinished candle. On each new bar, it first rebuilds the Camarilla ladder. It scans the previous 20 completed bars for the highest high and the lowest low, takes the difference as the range it calls R, and from that derives the unit spacing, multiplying R by 1.1 and dividing by 4. The upper lines H3 and H4 sit 1 and 2 units above the latest close. The lower lines L3 and L4 sit 1 and 2 units below it. And the central pivot P is the average of the high, the low, and the close. Next, it inspects the just closed bar for an engulfing pattern. A bullish engulfing is a green bar that fully covers the previous red bar's body. A bearish engulfing is the mirror image. This candlestick confirmation is what separates a genuine rejection from a simple touch. Now the entries. There are 3 behaviors, each with mirror long and short rules. First, the engulfing reversal. For a short, the signal bar must poke its high up to or through H3, yet still close below H4, stretched into the upper band but not broken out, and it must be a bearish engulfing that closes above the central pivot. The strategy then sells the rejection, places its stop just beyond H4, and targets the central pivot P. The long is the exact mirror. The bar dips to or through L3, closes above L4, forms a bullish engulfing below the pivot, and the strategy buys with a stop beyond L4 and a target back at P. Second, the breakout. If a bar simply closes beyond H4, that's treated as upside momentum, and the strategy buys with its stop set back at H3 and a target projected a fraction of the range beyond H4. A close beyond L4 mirrors this to the downside. Third, the hedge. When hedge mode is enabled, a breakout entry is allowed to open even while an opposite reversal trade is still live, so a fade caught wrong by a real break is met by a breakout position alongside it. The 2 opposing legs net out directional risk during the transition. Every candidate must also clear a minimum reward to risk filter and a spread check before any order is sent. Let's look at the actual MQL5 code as it appears in MetaEditor. At the top are the input parameters you can adjust in the strategy settings. Lookback, defaulting to 20, sets how many bars build the Camarilla bands. The stop buffer fraction and the breakout projection fraction control how far the stop sits beyond the band and how far the breakout target projects, both as fractions of the range. The minimum reward to risk, set to 0.8, is the floor a setup must clear. Hedge mode, defaulting to 1, allows a breakout leg to open alongside an opposing reversal leg. There's also a maximum spread filter, the base lot size, and a magic number to tag the trades. Below the inputs are the two reversal signal blocks. The short block fires when the signal bar's high reaches or exceeds H3, its close stays at or below H4, its close is still above the central pivot P, and a bearish engulfing has formed. When all of that is true, it calls try open with an order type of sell, setting the stop just above H4 and the take profit at the pivot. The long block is the mirror. When the bar's low reaches or dips below L3, the close holds at or above L4 and below the pivot, and a bullish engulfing appears. It calls try open with a buy, placing the stop just below L4 and again targeting the pivot. Finally, inside the try open helper, you can see the order actually being sent. A single conditional chooses trade.buy for a buy order or trade.sell for a sell, passing the volume, the symbol, and the normalized stop loss and take profit. That one line is where the reversal long and short both reach the market, but only after the reward to risk check has passed. Now let's bring this to life on the chart in front of you. You can see the Camarilla ladder drawn as horizontal reference lines. Near the top sit the upper bands, the H3 fade edge and the H4 breakout band. Across the middle runs the central pivot P, the reversion magnet. Toward the bottom sit the lower bands, the L3 fade edge and the L4 breakout band. Watch how price interacts with these lines. We begin on the left, with price sitting near the central pivot and starting to drift lower. Candle by candle, sellers push the market down, away from the pivot and toward the lower band. By the third candle, price has slipped right into the lower zone. Its low pokes down through the L3 fade edge, the level where the strategy considers price stretched to the downside. Notice, though, that the close holds above the L4 breakout band. This is the precise condition the expert advisor is looking for on the long side, stretched into the lower band, but not broken clean through it. Then comes the confirmation. That same candle opens lower but reverses hard and closes back up above the prior candle's open, a bullish engulfing pattern that completely covers the previous red body. That candle is the rejection the strategy waits for, with the low having tagged L3, the close holding above L4, and the bullish engulfing confirmed below the pivot, the buy entry marker prints. The expert advisor goes long, placing its protective stop just below the L4 breakout band and setting its take profit at the central pivot. From there, follow the price higher. The next candles lift steadily off the lower band, working back toward the middle of the range. The long is simply riding the bounce back toward fair value. When price reaches the central pivot, the take profit marker prints and the trade is complete, a clean mean reversion move from the lower edge back to the pivot, exactly as the logic intends. Now watch what happens next, because the market doesn't stop at the pivot. Momentum carries price up through P and onward toward the upper bands. Candle by candle, buyers extend the move until price stretches into the upper zone. The high of our signal candle pushes up to and slightly through the H3 fade edge, while the close stays below the H4 breakout band. That's the upper band mirror of what we saw earlier, price stretched high, but not broken out above H4. And again, the confirmation arrives in the candle's shape. This bar opens higher but then sells off and closes back below the previous candle's body, a bearish engulfing. With the high tagging H3, the close sitting below H4 but still above the pivot, and the bearish engulfing confirmed, the sell entry marker prints. The expert advisor goes short, placing its stop just above the H4 breakout band, and, once more, targeting the central pivot below. Price then rolls over. The following candles step down from the upper band, and the short rides that rejection back toward the middle of the range. When the market reaches the central pivot, the second take profit marker prints, and the trade is closed. Both moves, long and short, did the same thing in mirror image. They faded an overextension at the band edge and aimed for the central pivot. Notice what every entry had in common. Each one required price to reach a specific band, hold without breaking the outer line, and then confirm with an engulfing candle in the opposite direction. The stop always sat just beyond the outer band, and the reward to risk had to clear the minimum filter before any order was sent. That structural discipline, a defined level, a confirmation, a stop beyond the band, and a pivot target, is the entire character of this strategy. It's a framework for studying how price behaves around pivots, not a promise about where any single trade will end. That brings us to the end of our walkthrough of the Camarilla Edge reversal hedge. We covered how it builds its Camarilla pivot ladder from a rolling high, low, and close, how it fades the H3 and L3 band edges with an engulfing confirmation, how it rides genuine breakouts beyond the H4 and L4 lines, and how its hedging layer manages a position caught on the wrong side. We also read the core entry conditions directly from the MQL5 source. Everything here is for educational purposes only and is not financial advice, a recommendation, or a solicitation to trade. If you found this breakdown helpful, please like the video, leave a comment with the strategy you'd like us to analyze next, and subscribe for more MT5 strategy analyses. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.